Hello, this is part 1 of the Chapter 3 lecture series on transaction analysis. Let's get started. In Chapters 1 and 2, we learned how to prepare financial statements and how to use them. We were given account titles and amounts, and we prepared financial statements based on these account titles and amounts. But where do those numbers come from? In Chapter 3, we are going to begin the process of learning where these numbers come from. I have provided the definition to the accounting information system. It is a system of collecting and processing transaction data and communicating financial information to decision makers. I have also included the definition of accounting transactions. Accounting transactions are economic events that require recording in the financial statements. A business engages in many, potentially thousands of events throughout its life. Some of these events must be recorded in the financial statements. These events are called accounting transactions. The reason why we must record these transactions in the financial statements is because these events impact the balance of asset, liability, and/or stockholders' equity items, meaning that they affect the accounting equation. The first section of Chapter 3 relates to transaction analysis. Transaction analysis is the process of identifying the specific effects of economic events on the accounting equation. Simply put, we are going to analyze transactions based on their effect on the accounting equation. To do this, we must remember the basic accounting equation that we learned in Chapter 1, which is assets equals liabilities plus stockholders' equity. Remember that this equation must remain balanced after each transaction is recorded. Before we can begin transaction analysis, we must first expand the stockholders' equity section of the basic accounting equation. Remember from Chapter 1, there are two pieces of stockholders' equity, common stock and retained earnings. Now let's further break down retained earnings. Remember the formula for retained earnings. Beginning retained earnings plus net income minus dividends equals ending retained earnings. And also remember the formula for net income, which is revenues minus expenses. So you can see that there are three things that impact retained earnings, which are revenues, expenses, and dividends. Revenues make net income go up and therefore make retained earnings go up. Expenses make net income go down and therefore make retained earnings go down. Finally, dividends make retained earnings go down. Now let's look at the example that we began in Chapter 1 involving Sierra Corporation. We looked at the financial statements for Sierra Corporation in Chapter 1. First, we looked at the income statement. The question in Chapter 3 is, where do these numbers come from? How do we know, for example, that they earned $10,600 in service revenue? We will learn what makes up this $10,600 and all of the other numbers you see here in Chapters 3 and 4. Next, we looked at the retained earnings statement. Remember, our beginning retained earnings is 0 because it is the first month of operations. The net income number from the income statement feeds into the retained earnings statement. We then subtract dividends, which gives us ending retained earnings of $2,360. Finally, we looked at the balance sheet. Again, the question is, where do these numbers come from? For example, how do we know that cash is $15,200? Now let's begin to learn the answer to that question. We are going to go through 11 events that Sierra Corporation engaged in the month of October and analyze these events' effect on the accounting equation. The first event involves issuing stock, which is typically the first transaction for a corporation. On October the 1st, cash of $10,000 is invested in Sierra Corporation by investors in exchange for $10,000 of common stock. Remember from Chapter 1, a corporation issues stock to investors in exchange for money. The stock represents ownership in the company. The investors get stock and the company gets money. So how does this event affect the accounting equation? What accounts are affected? The two accounts impacted are cash and common stock. Sierra is getting cash, so its cash balance is increasing, which makes its assets go up. So we would enter a plus $10,000 in the cash column. Common stock is also going up because stock issued has increased, meaning the claims of owners have increased. An increase in common stock causes an increase in stockholders' equity. So we would enter a plus $10,000 in the common stock column. It is very important to remember that after each transaction is recorded, the equation must remain balanced. In this example, notice that each side of the equation is affected, the asset side and the claims to asset side. When this happens, the movement of the sides needs to be in the same direction, meaning both sides should increase or both sides should decrease in order to keep the equation balanced. Now let's talk about the second event. On October the 1st, Sierra borrowed $5,000 from Castle Bank by signing a 3-month, 12% $5,000 notes payable. In this transaction, cash and notes payable are affected. Cash is going up, which causes assets to go up. Notes payable is also going up. It is going up because Sierra Corporation's obligations are increasing because they now owe Castle Bank money. An increase in notes payable causes an increase in liabilities. So we would have a plus $5,000 under the cash column and a plus $5,000 under the notes payable column. On October the 2nd, Sierra purchased equipment by paying $5,000 cash to Superior Equipment Sales Company. In this transaction, equipment and cash are affected. Cash is going down, which causes assets to go down. The balance in the equipment account is going up because Sierra now has a new piece of equipment. This increase causes assets to go up. So the net effect on the equation is a wash. When a transaction affects the same side of the equation, one account must go up and one account balance must go down in order to keep the equation balanced. On October the 2nd, Sierra received a $1,200 cash advance from R. Knox, a client. This transaction introduces a very important concept in accounting. In this transaction, Sierra receives cash from customers. Because their cash balance increases, then this transaction must be recorded because it affects the accounting equation. The question is, what other account is affected? If you are thinking that we need to recognize a revenue, you would be incorrect. We do not recognize revenue until we earn it. When a company provides services such as Sierra to earn a revenue, it cannot recognize revenue until the service is performed. Sierra has not performed the service for R. Knox and therefore cannot recognize the revenue. Instead, we have to recognize the obligation that Sierra now has to perform those services for R. Knox. Sierra is now obligated to perform $1,200 worth of services for R. Knox. Remember that our obligations are liabilities, so we must record a liability. The specific liability that we recognize is unearned service revenue, which is an account that indicates services that we have been paid for but we have not yet performed. Sierra's cash balance increases, which causes its assets to increase, and Sierra's unearned service revenue balance increases, which causes its liabilities to also increase. So we have a positive $1,200 under cash and a positive $1,200 under unearned service revenue. On October the 3rd, Sierra received $10,000 in cash from Copa Company for guide services performed. In this event, Sierra is being paid for services rendered. It must recognize the increase in cash, which causes assets to increase, and it must recognize the revenue because they perform the services. When revenues increase, net income increases, which causes retained earnings to increase, which finally causes stockholders' equity to increase. So we would have a positive $10,000 under cash and a positive $10,000 under revenue because stockholders' equity is increasing. On October the 3rd, Sierra Corporation paid its office rent for the month of October in cash, $900. In this event, Sierra must record the incurrence of rent expense for the month of October and the payment of the rent. Cash is going down, which causes assets to decrease. Rent expense is going up because they have incurred the expense. When expenses go up, net income goes down, which causes retained earnings to go down, which causes stockholders' equity to go down, as indicated by the minus sign. This minus sign does not mean expenses are going down. It means that because expenses are going up, stockholders' equity is going down. On October the 4th, Sierra paid $600 for a one-year insurance policy that will expire next year on September 30th. This transaction introduces another important concept in accounting. In this transaction, Sierra is paying for something that will provide benefit for multiple periods. Sierra's time period is the month of October. This payment covers a full year or 12 time periods. Many students automatically assume that Sierra has incurred an insurance expense. Those students are incorrect. Because this insurance will provide Sierra benefit for more than the current period, then Sierra must recognize it as an asset. Remember, assets are things that will provide the company benefit in the future. This payment will provide Sierra benefit in the future, so therefore it is an asset. The specific asset that we use is prepaid insurance. It goes in the current assets section of the balance sheet. Sierra's cash account is decreasing and its prepaid insurance account is increasing, so the net effect on assets is 0. On October the 5th, Sierra purchased an estimated 3 months of supplies on account from Aero Supply for $2,500. This transaction exemplifies 2 important concepts. First, you must remember that any time a company buys supplies, the asset account supplies is increased. We don't expense these supplies because we haven't used them yet. Second, you need to note the words on account. You may also see on credit. This means that we are getting the supplies now, but will pay for them later. So Sierra's obligations are increasing because it now owes for these supplies. The specific account that we use is accounts payable. The balance in accounts payable is increasing, which causes our liabilities to increase. On October the 9th, Sierra hired 4 new employees to begin work on October 15th. The question is, does this event affect the accounting equation? The answer is no. This is an example of a business transaction that is not an accounting transaction because it has no effect on the accounting equation. On October 20th, Sierra paid a $500 dividend. In this transaction, cash and dividends are affected. Remember from Chapter 1 that dividends are not an expense, but instead go directly to the retained earnings statement. Dividends are increasing, which causes retained earnings to go down, which causes stockholders' equity to go down. And obviously cash is also decreasing by $500, which causes assets to decrease by $500. Employees have worked 2 weeks, earning $4,000 in salaries, which were paid on October 26th. In this transaction, Sierra must recognize the payment of cash and the incurrence of salaries and wages expense. Cash is going down, which causes assets to decrease. Salaries and wages expense is going up, causing net income to decrease, which causes retained earnings to decrease, which causes stockholders' equity to decrease. This completes part 1 of the Chapter 3 lecture series on transaction analysis. Now let's move on to journal entries.